Hello and welcome to TradeFlow Television,
bringing you valuable analysis and actionable intelligence
through the global commodity markets.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets. Workers at Antofagasta Minerals' Zaldívar copper mine in Chile have voted in favor of strike action after rejecting a pay offer, the mine's union said on Friday. The union said in a statement that 99% of its members had rejected a collective pay offer and a strike had been set for July 15, pending government mediation. The union said it regretted the need for a strike when the Chilean economy is in the doldrums and mining is among its primary earners, but claimed Antofagasta Minerals was attempting to strip workers' contracts of existing benefits in the latest negotiations. Major copper miners operating in Chile have largely maintained production despite economic shutdowns necessitated by the outbreak of the novel coronavirus in Chile in March. However, in recent weeks, as the virus has spread around the country and thousands of mine workers have fallen ill, miners have stepped up safety protocols, tightened shift patterns and suspended construction projects, raising fears about an, as yet unseen, impact on production.
Moving on to the top news in the energy sector.
India's Reliance will load its first cargo of Venezuelan crude in 3 months this week in exchange for diesel under a swap deal the parties say is permitted under the U.S. sanctions regime on the Latin American country, according to a Reliance source and a shipping document from state oil firm PDVSA. Washington has exempted some Venezuelan oil trade from sanctions, when transactions are in exchange for fuel and food or to repay debts rather than for cash. But that trade slowed as the U.S. tightened restrictions and refiners, shippers and insurers have been steering clear of Venezuela to avoid any risk they may fall foul of sanctions.
The International Energy Agency bumped up its 2020 oil demand forecast on Friday, but warned that the spread of COVID-19 posed a risk to the outlook. The Paris-based IEA raised its forecast to 92.1 million barrels per day, BPD, up 400,000 BPD from its outlook last month, citing a smaller than expected second quarter decline. While the oil market has undoubtedly made progress, the large, and in some countries, accelerating number of COVID-19 cases is a disturbing reminder that the pandemic is not under control, and the risk to a market outlook is almost certainly to the downside, the IEA said in its monthly report.
We will now look at the top news in the agricultural sector.
China booked its second-largest single-day U.S. corn purchase on record, according to U.S. Department of Agriculture data released on Friday, as the country works to fulfill its Phase 1 trade deal obligation to dramatically increase U.S. farm product imports. The USDA said China bought 765,000 tons of corn for shipment in the current marketing year, which ends August 31, and 600,000 tons for shipment in the following year. China also booked deals for 130,000 tons of U.S. hard red winter wheat and 190,000 tons of U.S. hard red spring wheat, the USDA said.
The U.S. government lowered its forecasts for domestic corn and wheat harvests on Thursday due to a cut in acreage estimates, but yields were still expected to remain robust due to good crop weather. The U.S. Agriculture Department's 2020 and 21 wheat production outlook for 1.824 billion bushels was 2.8% below its June forecast and near the low end of market expectations. The cut sparked a rally in wheat futures, which jumped to their highest since April 24 after the data was released. USDA pegged average wheat yields at 49.7 bushels per acre, down 0.1 bushels from its June estimate and the third largest on record if realized. U.S. farmers are about halfway through the harvest of the winter wheat they seeded last fall. Corn production for the 2020 and 21 marketing year was pegged at 15.000 billion bushels, based on a yield of 178.5 bushels per acre, USDA said in its monthly supply and demand report. That compares with the government's June estimate of a 15.995 billion bushel harvest and yields of 178.5 bushels per acre. Corn futures, which had been trading lower before the report was released, sank 3% to a 10-day low.
Next we have agricultural price moves.
U.S. corn and soybean futures prices fell on Friday on expectations for beneficial rains in crop-growing areas and as President Donald Trump said the country's relationship with trading partner China was severely damaged. A monthly U.S. Department of Agriculture report pegged America's harvests below analysts' expectations, although the estimates were not enough to pull crop prices higher. Traders are paying close attention to weather forecasts because the U.S. corn crop is in a key stage for development. Yields are important because the USDA previously estimated that farmers planted fewer acres than analysts expected. The most active Chicago Board of Trade corn futures fell 12-1/4 cents to $3.44-3/4 and reached their lowest price since June 30. Soybean futures fell 10-3/4 cents to $8.90-3/4 and hit their lowest price since July 1. Most active CBOT wheat futures closed 9 cents higher at $5.34 per bushel and set their highest price since April 24.
London cocoa futures edged further away from this week's 20-month lows on Friday on lingering worries that potential political upheaval in top producer Ivory Coast could pose risks to production. Raw sugar and Arabica coffee prices closed down. September London cocoa settled up £15, or 1.0%, at £1,578 per tonne, having hit a low of £1,545 on Wednesday. October raw sugar settled down 0.08 cents, or 0.7%, at 11.76 cents per lb. September Arabica coffee settled down 1.35 cents, or 1.4%, at 97.4 cents per lb.
White sugar markets was sitting around the 50% retracement level, resulting in many people to speculate what was going to happen. The market is clearly broken and now dropping away from the 50% retracement level. As indicated in the chart, the market still has room to drop further, but is what appear 325 to 305 range is your starting off buy zone on physical. The last time 300 area was seen was in April 2020, and it strongly recovered from that level to highs of 398 by June 2020. Prior to that, this 300 area was sighted in 2018, and before that you have to go back to 2008.
We will now take a look at energy price moves.
Oil prices climbed more than 2% on Friday after the International Energy Agency (IEA) bumped up its 2020 demand forecast, but record-breaking new coronavirus cases in the United States tempered expectations for a fast recovery in fuel consumption. Prices also found support after data showed U.S. energy firms cut the number of oil and natural gas rigs operating to a record low for a 10th week in a row. Brent crude settled up 89 cents, or 2%, at $43.24 a barrel, and U.S. oil settled up 93 cents, or 2.4%, at $40.55 a barrel.
Moving on to metal price moves.
Shrinking nickel demand and a large surplus are unlikely to push London Metal Exchange prices lower, as excess metal is in alloys, which cannot be delivered against contracts on the exchange. Benchmark LME nickel prices at around $13,500 a ton are at their highest since late January, and up about 25% since March, when COVID-19 lockdowns saw economic activity slump.
Copper was set for its weekly biggest rise in more than 2 years on Friday, with prices surging to pre-coronavirus crisis levels as Chinese demand rebounds and speculators turn bullish on the metal. Benchmark copper on the London Metal Exchange (LME) was up 1.9% at $6,417 a ton at 1600 GMT. It was up more than 6.6% this week, its 8th consecutive weekly gain and the biggest since February 2018, and trading at its highest since May 2019, having risen from a low of $4,371 in March.
Finally, we have the most recent news on the financial market.
The dollar slipped on Friday, as its safe haven allure diminished, on hopes of a potential vaccine for the novel coronavirus that outweighed concerns about the surge in infections in the United States and around the world. The U.S. currency posted its largest weekly percentage loss against a basket of major currencies in a month. In late afternoon trading, the dollar index fell 0.2% to 96.624. The dollar also slid after U.S. producer prices unexpectedly fell 0.2% in June, following a 0.4% rebound in May, as the economy battles depressed demand amid the COVID-19 pandemic. Reflecting the market's increased risk appetite, the euro rose 0.2% against the dollar to $1.1300, while the British pound was up 0.1% at $1.2631. The dollar also fell to a two-week low against the safe haven yen. It was last down 0.3% at 106 yen and 92 sen.
Asian shares and U.S. stock futures fell on Friday as record-breaking new coronavirus cases in several U.S. states stoked concern about economic recovery, while investors looked forward to earnings season. MSCI's broadest index of Asia-Pacific shares outside Japan fell 0.74%. Australian stocks declined by 0.31% as an extension of loan payment deferrals hit the banking sector. Japanese stocks were down by 0.58%. Shares in China fell 0.72% from a 5-year high, the first decline in more than a week, as state media discouraged retail investors from chasing the market higher and worries about Sino-US tensions re-emerged. E-mini futures for the S&P 500 erased early gains to trade down overnight 0.75%. That is all for today's news on the commodity market. Stay tuned to TradeFlow TV as we continue to provide you with more updates. You can also follow us on Twitter at TradeFlow TV1, which allows you to watch our program on your mobile device or desktop.